So let's dive into our questions for today, and we're kind of in the tax realm for question number one. It's from Kenneth via text message, and he writes, once I turn 73, I know I'll need to take RMDs from my IRA. Can you explain how to plan for those withdrawals and avoid unexpected tax hits? Kenneth, thanks for the question. RMD stands for Required Minimum Distribution. You probably have heard about this. It applies to your IRA. It also applies to your 401k, other employer plans when you reach a certain age. And for the majority of time that the RMD existed, that age was 70 and a half. But Secure Act 2.0 changed that and started it on a path going upward. The idea being here that the RMD age does currently stand at 73. And Kenneth is saying, once I turn 73, I know I will need to take an RMD. But the first piece of the question here, we need to determine if that's true, Kenneth, because it is not going to stop at 73. It's going to go to 75 for people born 1960 or later. So for most of Americans who have not yet taken an RMD, it is going to be 75. So you need to determine your age first. So think about that. If you were born before 1960, it's going to be 73 if you haven't already started taking them. And if it's 1960 or later, it's going to be age 75. The amount of the RMD is determined by the IRS, and it is a very convoluted, complicated tax table, or really a life expectancy table, Tim, that determines it. But roughly, it is going to be 3.5% to 4% of the value of your qualified accounts on December 31st of the previous year.
Yeah, isn't that confusing?
Yeah.
So,
yeah. Might need to say it again.
Yeah. So, I mean, it's probably unlikely that a lot of people haven't started taking distributions from their IRAs or the retirement accounts, because if you've retired, you're more than likely you're supplementing your Social Security with some distributions from that already. But at that time, whether it's 73 or 75, they do have the life expectancy table, the IRS does, and it's a quick calculation to determine how much you actually have to take out in that given year. The good thing, it's not unexpected, because you can find out January 1st, right after the year end, what your RMD is going to have to be. And so there are some things that we can do that we can minimize taxes. Now, any dollar you pull out of a retirement account will be taxed as ordinary income, but there are some options and some things that are available, such as qualified charitable distributions. If you're a giver to a church or a charity, that you can actually give your RMD or a portion of it directly to a qualified charity, and that does not have to come to you and be included in your income taxes. So that is one easy way to reduce your income tax in that given year and help offset that RMD. So there are definitely some situations where we can identify exactly how much that RMD is going to be and what your taxes will be on that RMD.
Yeah, and I think it's important to point out, too, we talked about how the RMD age has been raised because of the Secure Act, but they did not raise the age of eligibility for the qualified charitable distribution. It is still 70 and a half, and in 2025, so as we get into this tax year, there's a big limit for that. So you can give as a qualified charitable distribution far and away more than what your RMD is likely to be. The cap for 2025 is $108,000, and that's pretty large, obviously, and it just has to be sent directly to the charitable institution. It has to be a 501c3 recognized there. If it goes directly to the institution, you don't have to claim it as income on your tax return. So for Kenneth's question, how can I avoid unexpected tax hits? That's a big way to do it, because this is valuable, Tim, for a lot of reasons with the RMD piece. But if you're already giving and you're in retirement now, you're likely not itemizing your tax deductions, and that gives you an opportunity to take a deduction for, in essence, a deduction. It's not really a deduction. It's just a tax-free gift in this case, but you're getting a tax benefit where you weren't normally if you were already giving money in after-tax funds.
So that really falls into folks that aren't even taking or having the required minimum distribution at this point, and you're 70 and a half, because if you are giving to your church or whatever it might be, and you're giving or tithing off your Social Security check or your pension check, well, now you could actually give from your IRA and have that distribution come directly from that account to the charity, and you're not going to have to claim that as income, because in most likelihood, you're not going to be able to itemize currently with the $30,000 plus standard deduction if you're married filing jointly. So since you're not going to be able to reach the itemized giving and taxes and all that good stuff that comes along with itemization, you can actually give and just reduce your actual income tax by reducing the amount of taxes that you actually have to pay, your income you have to pay on.
Yeah, and I would say, too, to wrap this up, too, Kenneth, I would not wait until RMD age to begin taking withdrawals. Your question suggests that that's where you are, or that's what your thinking is. You know, Tim mentioned most of our clients are probably not going to be that old before they start taking withdrawals. And if you think about it, if you really are intentionally not doing that, maybe you don't need the money, or maybe you're treating your retirement plans as a just-in-case retirement. We have a lot of people who, without a plan, that's kind of the way they look at those 401ks and IRAs, is I'm going to live off of my fixed income, like Social Security, maybe there's a pension, and I'm not going to touch this in case unless I need it for something like an emergency. But think about how that could play out. If you retired at age 65 and you stopped and you were no longer contributing to these employer plans or IRAs anymore, what if you didn't have, and you made it all the way to 75 without taking a withdrawal? That's 10 years of growth, potentially doubling, depending on how you're invested, and the performance of the market could potentially double the value of your IRAs or qualified plans, and that means that RMD is going to be much greater and could, once you get to the required piece of that, push you into a higher tax bracket, and that comes with all sorts of problems.
Absolutely, because as the graduated tax system works, the more income you have, whether you've got Social Security, you got the pension, and Social Security isn't taxed at the state level here in Arkansas, but there is a reduced tax at the federal level. But as you earn more money, whether that's through pension income or retirement income, now you're actually having to pay tax on Social Security as well. And so your income tax rates are going to just continue to increase based on the higher amount that you're pulling out of the IRA. And if the RMD is pushing you even into a higher bracket, you're going to be you're going to have a lot less take-home pay and a lot more taxes to go through. But I think there's a lot of strategies, if you're 65 or 67 or whatever, before that RMD age, to use some of those dollars out of the IRA and maybe move those to even an after-tax account, so that now you don't have to worry about maybe even meeting some of the higher requirements to have premiums on your Part B Medicare and things like that. So there's a lot of strategies that we would want to go through to make sure that you're taking what you need to from the IRAs, but not necessarily waiting and pushing everything off to where you're going to actually have difficulty and have too much income to get you into a much higher tax bracket.
There's so much about retirement that is out of your control, but you need to be able to plan and control what you can control. And I think this falls into alignment there. You want to control your withdrawals, because if you don't control your withdrawals now, you might not be able to control them later, because the government's going to require you to take out a certain amount. So, Kenneth, I would encourage you to create a retirement income plan. And if you want that, you can reach out and go through the Gen Wealth Ready to Retire process with us. Just call toll-free 866-653-PLAN. That's 866-653-7526. That goes for Kenneth or anyone else who is worried about RMDs, taxes, and wants to create a retirement income plan unique to them.